And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Yes, we're live. We did survive the freeze here, and of course, I'm glad you're back with us today. So, always want to be a little bit cautious, when there's a lot of ice on the roads, and want to jeopardize Brent and his little Mazda Miata that's on the freeways. Just not really worth it. The new generation, these kids these days, they're always inventing something new. So have you heard about this new thing called Scrawlish? Have you?
Scrawlish?
Scrawlish. It's a new way to write.
Oh.
So yeah, it uses a set of symbols to represent letters. So a symbol can represent a letter or a sound, and that way you can theoretically write faster, right? Take notes.
And it's legible.
No, it's not legible. It's symbols. So if you don't know how to read it, you're not going to understand it. So this is the whole point about Scrawlish, right?
So this is not like the Palm Pilot code.
No, not at all. But this is the funny thing, right? So they've gone to all this effort to create this new kind of language, right? This thing called Scrawlish, right? And it's very cool looking on paper, and nobody can read it, so it's good. But it's also called shorthand. We developed that like 50 years ago to take stuff. So, you didn't want to learn cursive. You didn't want to learn shorthand in school. So now you come up with a new thing. Kids these days. Anyway, so, it is funny, though. It is interesting because, it's like I was watching my daughter the other day, and she was typing on her laptop, and she's hunting and pecking.
With 2 fingers?
Oh, with 2 fingers on the laptop.
Yeah.
And I go, didn't you take typing in school? And she goes, no, they don't teach typing anymore. And I did not know this, right? They don't teach typing in school anymore, at least that I'm aware of, right? According to her, my daughter, and of course, she's not the best source of information, but things get a little dramatic. But she says they don't teach typing anymore. It's not an elective. And I'm like, okay, in a world where we're all going to computers, shouldn't typing be like the main requirement of school?
You would think.
You would think. But no, she was even telling me like most of her friends hunt and peck. And, this is interesting because, if you learn to type, you use all your fingers and you're a lot faster at it. So.
The dumbing down of society.
I don't know. But I guess somebody just said, we don't have typewriters anymore. We all type now.
Well, they did update the class at one time and called it keyboarding.
Well, this is true.
What a concept.
They did, but apparently they've got rid of that. Now it's just a class called thumbs. So, and they are thumb critics. Let me tell you what, they can criticize you quickly with your thumbs. Anyway, lots of deep freeze here over the last couple of days. Here's the interesting thing, though. This will have an impact on economic data. And, one of the things that we kind of keep talking about is, what's going on with the economy, et cetera. And of course, a lot of people were shut in. And not surprising, if you were kind of watching social media, on Saturday and Sunday, there was a picture from H-E-B. So if you don't live in Texas, right, you're not familiar with H-E-B, but H-E-B is like one of our big grocery stores. It's kind of like a Randall's or a Safeway or an Albertsons. But anyway, showing the guy had gone into H-E-B to get groceries ahead of the freeze, and most everything was sold out. So
I was there yesterday. The entire shelf, 3 tall, from one end to the other, where the toilet paper used to be.
Yeah.
I mean, blank.
Yeah.
What is it about freezes and toilet paper?
I don't know. Everybody's afraid that you're going to run out of toilet paper during freeze.
Boy.
That's what they make snow for. So anyway, Anyway, so yeah, but this is going to be an impact on economic data, right? So everybody went out and spent a bunch of money stocking up on toilet paper and other things. It was also interesting though at HEB. Of course, you live in Texas when two things happen, right? And then we saw this during COVID, right? So during the COVID shutdown, everybody would panic, went out and bought everything, and everything was empty out of the stores except for the vegan aisle. There was plenty of food. All the Beyond Meat was there in the vegan aisle. But you live in Texas when you go to HEB and there's unsweetened tea but no sweet tea.
True that.
Right?
Yep.
If you don't know sweet tea, you don't know Texas. But yeah, HEB completely sold out of sweet tea, according to this video. But there was plenty of unsweetened. You could get that. So anyway, but that's good. So the point is that's going to lead to a pickup in economic activity. So we're going to see potentially a little spike in retail sales. Also, utility usage is going to spike. So we're going to see a pickup there in terms of, the amount of money spent on utilities, natural gas, etc. So again, there's these things that happen economically that will sustain some economic activity, and the timing of this was, kind of nice because if we'd already kind of see a little bit of weakening in the economic data, so this is going to add a little bit of juice. Not a lot. I mean, it's only a couple of days, but that's going to add some juice back to the economic data. So again, just weather matters, and it's going to make kind of predicting the next quarter of economic activity a little bit more difficult for economists. So we're going to see a little bit of variation of that. Okay. Now, what do you need to know before the bell this morning? We got a little bit to catch up on since last week, and I know we're out. I apologize. Hope you've been watching our daily commentary. That's been out on the website. We updated that yesterday. But the market continuing to basically not do a whole lot. We just kind of remain trapped in this consolidation range that we've now been in for really since mid-December. Markets haven't really made much of an advance here. Continuing to work off that overbought condition. We're about halfway through that process. Have a little bit more to go, but this kind of churning action of the market is keeping that from happening more rapidly. Again, if the market's just sold off, we would get oversold very quickly, but because of this kind of back and forth of the market, it's causing this reduction in that overbought relative strength index to take a little bit more time to get to an oversold condition. We remain in a MACD sell signal as well. We're working through that process as well. We are approaching zero, and that's, we're again about halfway through that process as well. So again, the market's doing fine. There's nothing really wrong here. Interestingly enough, the trades that were wrapping up the end of last year, small cap, mid cap, international, emerging markets, those have all kind of given up the ghost. Small caps have come under a good bit of pressure here lately. We're also seeing a rotation from the last year. The last 2 months of the year had some good winners going on in kind of some of the beaten down sectors, and a lot of that was just repositioning for the end of the year. Those have all come under pressure. The big winners of the last couple of days in particular have been NVIDIA. AMD was up like 8% yesterday. So seeing money go right back into that previous Magnificent Seven trade from earlier last year. The question is, are we going to kind of repeat that all over again, where it's just a very narrow market advance with a lot of stocks lagging? We'll see. It's a little too early to tell, but we are starting to see some of that rotation. In particular, we saw this last week, that consolidation back into that mega cap growth trade has certainly picked up some steam. But again, markets are holding here above the 20-day moving average. Not a lot of risk here at the moment. We have a good bit of stock, the percentage of stocks above the 200 and the 50-day moving average remain fairly high. So again, there's not a lot of risk of a big downside move here currently. But again, this market's just kind of not going anywhere until we get kind of some of these conditions overbought. This morning, futures are pointing lower. We've seen this over the last couple of days, but markets have rallied back by the end of the day. We'll see if that happens again. And again, we're right in the middle of earnings season. We're going to talk some more about that coming up on today's show. But that's what you need to know before the bell this morning. When we come back, we will talk a little bit about earnings getting underway this week. We started with the banks on Friday, but we're now starting to see more and more stocks coming in. Starting next week, it gets real busy. So we'll talk a little bit about what to expect when we come back right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
How about we just start here with no music? So the panels are still frozen up this morning, but we're getting there slowly but surely, trying to get things back on track.
Everything worked yesterday.
Exactly. That's what they normally say. So anyway, talk a little bit about earnings, quarter four season. So now I know it's January of 2024, but we're now starting to report the earnings from quarter four of last year. So that has gotten underway on Friday. We had JP Morgan, Morgan Stanley, a couple other big banks report. Right now they're starting to trickle in here a bit, and we've got Charles Schwab today, Alcoa, Discover, U.S. Bancorp, Kinder Morgan, Citizens Financial Group, Prologis, a few others. So again, they're starting to trickle in. Now next week earnings are going to get really busy. We'll get into over the next probably 2 weeks, we'll have about 80% of the S&P 500 will kind of report. So there'll be a big flurry of earnings as we start getting into next week. But nonetheless, when we take a look at earnings and think about where we are, and this I put this article out yesterday, so I've got some charts this morning that we'll go through here real quick. But if you want to get access to the article, just go to the website, Real Investment Advice. And while you're there, make sure and get your ticket for the upcoming Economic Summit which is not this Saturday, but next Saturday. It's coming up pretty quick. So, but talking about quarter four earnings, we always go through this, and we every quarter we call this, it's millennial earnings season, because everybody gets a trophy. Why? It's because we cut estimates to the point that companies can beat the number. And it's interesting. If you went to your doctor, right, and your doctor said, "Well, you're healthy," right? So 8 months ago, he said, "Oh, you're completely healthy," and you go back every month, and every month he says, "Yeah, you look healthy. Well, you're not quite as healthy as you were last month, but you're still healthy." And every month is going along, it's just the prognosis is getting worse and worse. And finally, it's just like, you couldn't have told me 8 months ago that there was a problem here, right? It took this long to get here. And this is the way it is with analysts. Why we put any faith in analysts at all
is surprising because their job is not to provide you good information. It's to support the stocks they do investment banking with. But nonetheless, we have these analysts come out and say, oh, these are what we expect earnings to be. Well, and let me just show you a good example of this. So can you show a chart this more? Okay. So here's the chart of quarter four estimates. So we started putting out estimates for the fourth quarter of of 2023 in February of 2022. So in February 2022, analysts said, oh yeah, earnings are going to be $236 a share at the end of next year. Right. Okay. Fantastic. Since then, they've done nothing but just ratchet those down. Every month, they just get lower and lower and lower and lower. And interestingly, earnings fell by $8 a share between November and December. So a very rapid cut to earnings as we wrapped up quarter four. I mean, even going into quarter four in October, they were more optimistic about the actual earnings numbers. And we're into the quarter, right? I mean, you're 3 months out from a company reporting. You should have a much better idea of what that company is doing than have to come back and slash your estimates by $8 over the course of 3 months, right? I mean, but nonetheless, this is where we are. So we wrapped up with estimates as of January the 1st, 2024. The estimates for quarter four were at $192. Now, that's down from $234 a share when they first started. So huge decline in this earnings. And of course, this is why, when we do this and we have these millennial earnings season, everybody's going to get a trophy, right? This is why there's every quarter is like, oh, well, we had 80% of companies beat estimates this quarter. And it's a great quarter, man. Earnings just came, companies came in and slammed earnings. That's because analysts are just that wrong. Always. And again, why do we trust it? I mean, you should have, if analysts were good at their job, right? And they were actually talking to these companies and doing what they say they're doing, and actually providing information that was worthwhile, you would not have a very high beat rate. Your beat rate should be 10%, because 90% of companies are meeting the estimates that you laid out, right? So you have a 10% beat rate. When you have an 85% beat rate, can you show this chart? When you have an 85% beat rate, on stocks, it just tells you how bad you are. But on average, we average about a 70 to 75% beat rate by companies over history. And, this is what this is saying is that analysts are wrong 75% of the time. So, there's a great statistician. He's a comedian. He's like, 1 in 5 children in the world are Chinese. That means that if you have 4 kids and you're going to have a 5th child, the odds are it's going to be Chinese. Right? So this is the problem with statistics, right? This is the problem with Wall Street analysts, right? Statistically, they cannot be this wrong all the time. So that means it has to be done intentionally. You cannot be this wrong all the time. So this has to be intentional. So just remember about that. So we've cut estimates now as we go into earnings, and this is going to lead to a very high beat rate. But again, this thing about cutting estimates has already started for 2024 as well, right? Just since we had the initial estimates for 2024, estimates for 2024 have already been cut by $10 a share as of January the 1st. So already their estimates for 2024 are coming down, despite the fact that they're saying, oh, everything's great. The economy's awesome. We're going to avoid a hard landing. It's going to be fantastic. We're going to have growth. We're going to cut rates. It's all great. We're already slashing earnings again. All right, so we're already setting up the next year. But here's the problem with all this is that if we take a look at earnings growth as currently expected, and this is going to be one of the big issues, estimates for 2024 are now hugely deviated. Now, if we go back through history, earnings kind of grow peak to peak at 6% on average. The troughs run about 5%. trough to trough on average. And so you can take a look at over time as the economy, and this makes sense, right? As the economy grows, earnings are going to grow with the economy. But currently, the growth trend of earnings is well deviated above what the long-term average growth trend is. So you're going to get, and throughout history, you get reversions in earnings for one reason. And these reversions, of course, happen during economic recessions, slowdowns, et cetera. And you can kind of see that drop in earnings that occurred during 2020. And the only reason that we did not have a bigger reversion in earnings in 2020 was because we came in with $5 trillion worth of checks to households, shut down the economy, had this supply-demand imbalance, but we fueled households to start buying stuff, and companies could charge more for those products, so earnings just went through the roof. And so we saw this recovery in earnings starting in 2022, right? So we had this brief decline in earnings that have turned around because of all that stimulus. Now, the question we have to ask ourselves is we are ex-stimulus. You all right, Brent? Brent was under the table over here just banging his head. So, but we're cutting earnings now, right, to beat these estimates. But the question is, at some point, we're going to have to mean revert earnings back to what the economy can actually generate. That's because that's where earnings come from. Earnings come from economic activity and economic growth. Same thing for corporate profits. If we take a look at GDP, over time, we had that huge spike in GDP, and that led to a surge post-COVID in corporate profitability. And that continues now, but the issue is that the S&P index is priced well ahead of what corporate profits are. And normally when you have big deviations from corporate profitability, you have a correction at some point. And that's because the economy cannot generate profits or earnings fast enough to keep up with what people are paying for asset prices. So again, you have this deviation that at some point is going to have to rectify itself, and this is a valuation problem. We talk about this all the time, but it's just a function of where we are, and because we have changed the underlying dynamic of the markets over the last decade, this is probably going to last longer than you expect. But eventually, at some point, you're going to have this reversion to the mean, only because the question becomes is where's all the spending going to come from next, right? We spent $43 trillion supporting economic activity over the last 13 years. So the question is what are you going to do over the next 13, right? What are you going to do for me now? It becomes the next question. And if we take a look at M2 as a percentage of GDP now, so M2 is basically the money supply in the system. We compare that as a percentage of the overall GDP of economic activity. You can see that huge spike that we did during COVID, right? It's just so far beyond any type of rationale. So we're going through this process now of correcting that monetary supply. But importantly, look back at that red line. And again, if you're driving right now, don't try to look at your phone, but you just go pull you can just get this article on the website. Quarter four earnings season gets underway. And you can take a look at the chart. But importantly, note that the M2 as a percentage of GDP started to escalate at a 45-degree angle post-2000. So this is a phenomenon of this surge in monetary activity post-1999. And then it just kind of skyrocketed during the COVID shutdown. Now we're in the process of reverting that, right? And a lot of that money is still in the system as a percentage of GDP. So as that monetary supply comes out of the economy is going to slow down. Just not enough to support it. I'll come back and wrap this conversation up after the break. Don't go away. Be sure to get by the website, realinvestmentadvice.com. Get your tickets for the upcoming Economic Summit, weekend after next, on the website now.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts, Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere, Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny's always saying, I can't retire. You can't. Visual Capitalist put out a graph this morning. The title of the graph is, How Much Longer Do You Have to Live? It's a very sobering graph for 6 o'clock in the morning.
The Real Investment Show podcast.
You look at this graph and then you find your age. It says, I'm going to die of roughly about 78. So I've got about 18 years left on my ticker. So I'm retiring soon.
At realinvestmentadvice.com.
The sand in my hourglass is running out.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Financial Fitness Friday, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Of course, it is Wednesday. It's hump day already. Talk a little bit about earnings quarter four as we get ready to kick things off. I want to go back to this chart real quick. We were just talking about just before the break, which is this M2 as a percentage of GDP as compared to GDP. And I want to, the reason this is important is I want to change this into a liquidity measure, right? I'm going to use the same data and again, what we're talking about is how much money is there, monetary supply, is convert this into a measure of liquidity by subtracting GDP from M2, right? So if I do that, I get a different look here, which is basically the contraction of M2. So we're going through this whole issue of contracting this liquidity from the markets, and not surprisingly, there's a fairly high correlation historically between this liquidity measure and the market. It runs with a bit of a lag, but we see this. Now, the market's been rallying here over the last year. We had 22% advance last year. It's great. Nothing wrong with that. But that's occurring as liquidity is draining from the system. So this is going to potentially put pressure. Now, unless this changes, right? Unless we start injecting more liquidity into the system and the Fed cuts rates and we start doing a lot of QE and we start printing some more money, et cetera, then this will change, right? We'll start to see the money supply grow again, and we'll see liquidity turn up, which would support the economic activity. Or we're going to see the opposite, which is the market comes to reflect the amount of money and monetary liquidity that's in the system. The problem that we have, of course, as always, is that, and I shouldn't say as always, because we haven't always had this problem. We've had this problem over the last 10 years in particular, is valuations. And, when we take a look at valuations, we take a look at, what's going on. And, of course, we have two measures of valuations. We have GAAP earnings, which are actual reported earnings, generally accepted accounting principles. That's reported earnings. That follows the accounting rules. That's what companies actually make. Then we have operating earnings, which are operating earnings less all the BS, right? So in anything that may subtract from earnings, we don't even count that. This is operating earnings this is how I would like earnings to be in a magical world of unicorns and fairies where absolutely nothing goes wrong, right? You should never use operating earnings for any measure of managing your portfolio, ever. You should only look at reported trailing earnings. That's all that matters. But nonetheless, we have to take a look at both because they're out there. But valuations right now on an operating basis, so operating earnings, again, operating earnings less all the BS, are still trading at 21 times earnings. Reported earnings are at 24 times earnings. So again, you just have a big gap between what's going on between operating and reported earnings. And that gap normally doesn't persist long. It can stay that way for a while, but with regularity, earnings will contract and they are going to meet at some point on this valuation base. In other words, you're going to have this valuation reversion. And that's just going to occur. And again, what causes that to occur is always hard to tell. But when we take a look at the gap between operating earnings and GAAP earnings that we have right now, that is exceedingly high. That deviation, there's a big gap between operating and reported earnings. So again, that's going to have to close at some point. Either operating earnings are going to stay where they are and reported earnings will catch up, or vice versa. But there's going to be a correction of some sort coming. And generally that's going to occur during either a recessionary contraction within the economy or at least just a significant slowdown in economic growth, and you get a valuation reversion. And again, it's just that's how markets work over time. And if we take a look at long-term kind of measures of the markets, whoops, I lost my chart. 1 second. We can take a look at valuation ranges historically. And again, we've been running a very deviated market really ever since 2008 when we came in and started all, $43 trillion worth of liquidity injections of QE and this and that and the other thing. We've just been running a market for 13 years now. And again, there's a lot of investors that have never seen a real bear market. They just never, have been through that. But we've been running a market that remains extremely overvalued relative to historical normal ranges of valuations. And so at some point, you're going to get a mean reverting event that is going to correct this overvaluation issue just because simply the market and the economy are not detached from each other. They operate. Earnings come from economic activity and the revenues that are generated from economic activity, right? So again, you can continue to overpay for stuff for a while because you're getting, you have zero rates, you can do lots of leverage, those type of things. But, eventually at some point, the rubber meets the road. Now, the problem is that we've seen over 13 years, it can stay this way for a very long time. But at some point, whether it's 5 years from now or 10 years from now, and again, these secular periods in the markets can last a lot longer than you think, right? But you're going to go through a period where you'll have this mean reversion. Now, that doesn't mean the markets crash and everything goes to zero and it's a complete disaster. But what it means is that you're going to go through a subsequent period of 10 to 20 years where markets return zero-ish and valuations catch up to reality. And again, you can go back through history and see this, right? After the run up from 1900 to basically 1929, the markets went sideways for about 20 years. Then post World War II to the early 1960s, the markets had this huge bull market. And then we went nowhere in the 1960s and 70s. I actually had a negative 10% return after 20 years. And you worked off those valuations. Valuation about 5 times earnings coming out of that period. Then from 1980-ish through 2000, you had 15% average annualized return during that secular bull market. And then you went nowhere for 17 years. So we've done 13 years now of this advance. And again, it can stay this way for another 5, 7, 10 years. But then you're going to go through a period of returns that are going to be disappointing. And that's just the way markets work. These secular bull, secular bear periods are all based on valuations and what the economy can actually generate. And with the amount of debt and leverage that we're putting on, it just suggests that we're eventually going to have to go through this kind of reversion period at some point. That's now, again, I'm not trying to be bearish, but I'm just saying this is kind of reality, is that, you don't know when this is going to occur. You don't know how this is going to occur. You don't know what's going to cause it to occur. We just know that these secular periods occur with regularity throughout history. And it's always interesting too, and this is one of the great fallacies of financial media and financial advisors around the world, is they tell you, oh, just put your money in the market, and over time you're going to 8% a year. Well, the problem with that statement is 100% of the market gains have occurred in 4 periods, 5 periods now. The other 4 periods had 0 rates of return. So it all depends on your lifespan, how long do you have, and where you start. If you happen to start in one of those periods where you have 20 years of 0 returns, you didn't do well. If you happen to be lucky enough to start your investing journey in 2009, you have 13 years of a great advance, but we're going to go through a period where it's not going to be so great. But when you look at it from the fact that 100% of the returns of the market came from 5 distinct periods, you just happen to be in one of those periods right now, as opposed to 2000 through 2017, where that period kind of sucked, right? You had some nice advances, but you also wound up giving them up twice. So again, it's important to measure. Anyway, this information is all on the website. So if you go to the website, realinvestmentadvice.com, and just click on yesterday's article on Q4 earnings, you can see all those charts and kind of do the analysis yourself if you want. So getting ready to kind of wrap things up. It's interesting right now. What you're going to see over the next couple of days on CNBC and everything else is all these CEOs and politicians from around the world. They're at the World Economic Forum, right, in Davos. This is led by Klaus Schwab, who is the head of the WEF and, of course, the big promoter of the global dominance movement, where basically the elites control everything. And it's interesting, they all flew in on private jets, etc., to talk about how to control the world and the importance of climate change and all these type of things. And of course, while they're there at this big confab doing that, this year's theme I thought was interesting. It's called Rebuilding Trust, because what they figured out is from last year to this year, they lost a lot of trust in some of the things that they've been doing, particularly revolving around the COVID pandemic. And now that all that nonsense is coming out, they figured out that they've lost a lot of credibility. So now this year's theme is how to rebuild that. But in the same process of that, you cannot find a hooker anywhere in Davos. There is a website called T4T, which is how you can book your escort for the week of Davos, and they are completely sold out. So again, it's kind of like a Baptist convention in Houston. Can't find alcohol anywhere. I'm Baptist, I can say that. Anyway, you have to make jokes of these people. I mean, come on. Yeah, they're controlling the world, and they're all up there hating on Twitter. They despise Twitter, and Elon Musk, the hero of the left when he was building EVs. Now he is now declared to be evil. Elon Musk is now evil, along with X. Free speech is a bitch. Anyway, all right. Be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts, Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere, Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
You know, when you're as old as Brent and I are, we remember the days where you had a bank account. And if you wanted checks, you had to pay for checks. If you wanted, any type of service from the bank, you had to pay for that. And that's how banks made money. And this is before we deregulated the banks and allowed the banks to get back into the brokerage industry and start basically making money hand over fist through proprietary trading, etc. And that led to and when banks could offset those fees with other revenue streams, and this is why when you take a look at bank earnings, which we're in the process of right now, take a look at bank earnings, and this I'm talking about the big banks, right? I'm talking about J.P. Morgan, Wells Fargo, Bank of America, etc. You take a look at like Bank of America, J.P. Morgan, take a look at their revenue mix. It's primarily trading, investments, those type of things that are making their revenue. Retail banking is a write-off for the most part. But it's interesting because the Biden administration's coming out, the Consumer Protection Bureau that they set up is coming out with new proposals to change how banks charge customers. And it's interesting because, these all sound like a great idea. They're terrible ideas. Since 2000, let me just read to you this little sentence here from CNBC. Since 2000, American consumers have paid an estimated $280 billion in bank overdraft fees, according to CFPB. During that time, the annual revenue of big banks derived from overdraft fees soared, helping along the boom in consumer debit cards tied directly to checking accounts. So, look, this is something Brent and I and every other Gen Xer grew up with, and baby boomer grew up with. You have so much money in the bank. You spend too much money. You write a check. You can't, as my dad says, you write a check, your butt can't cash. You're going to have to pay a fee, right? There's a penalty. And guess what happens? You pay that $25, $30, and guess what you do the next time? You're a little bit more careful about writing that overdraft, right? So it's a penalty, and yes, it's a fee, and it's the price of doing business. Right? If I've got to advance you, if you come to me, I do hard money lending, right? You want to come to me and borrow money, I'll loan it to you, but the VIG is pretty high, right? And the collateral's steep. So that's the reality of life, right? Those with the money make the rules, right? But in today's society, right, we have to be doing, we have to protect the individuals, right? Instead of teaching them financial responsibility, let them suffer with the penalty, we got to do this. But that's okay. We have a solution for this, and I'm going to tell you why this is a terrible, terrible idea. Here's a quote from Joe Biden. For too long, some banks have charged exorbitant overdraft fees, sometimes $30, that often hit the most vulnerable Americans the hardest. Well, yeah, of course, the people that are getting hit with overdraft fees are those that are living paycheck to paycheck, which is about 80-90% of Americans. Is what it is. Banks call it service. I call it exploitation, according to Joe Biden. Okay, so the new regulations are going to apply to banks with more than $10 billion in assets. It's about 175 institutions. And taking into account these banks make are about 80% of the overdraft fees charged. That's because most Americans have, 5 banks make up 60% of our banking system. It's not hard to get there. So the new proposal, right, is to now have a credit line. So what they're trying to propose is that when you open a checking account with a bank, you now have to also apply for a credit line to protect you against the overdraft. Now, here's the problem with that. And that sounds like a good deal on surface, right? So it's basically overdraft protection, and basically you can get this at the bank all the time. I have it on my checking account. I'm not that I overdraft, but if I happen to overdraft, I have overdraft protection. There's no charges, and I have to just pay it off by the end of the month. It's just there, right? Here's the problem with this new idea. Under this option, the large banks would offer overdraft loans for profit, provided the banks treat the funds they advance as credit line loans. Okay, so great. I can provide you a loan that I charge you 6-7% on. Now, let's think about the math here for just a second, right? I overdraft a check. I pay $25, $30, whatever, one time, and I'm done, right? It's finished. I get myself back on track. I get my paycheck in. I pay the overdraft fee, and I just don't do that again. Here's the problem with these overdraft lines. It's easy to just keep the credit line, right? So now I'm negative on my account. This is like buy now, pay later, right? This whole other issue we've got going on with that type of loans. But now consumers get into this credit line, and let's say depending on the size of the credit line, whatever it is, but now I'm paying a monthly fee on the credit line. So that's going to wind up potentially costing me way more at some point, depending on how long I'm staying in this credit line overdraft situation, than a $25 fee. So, if I'm charging 7%, I'm overdraft $100, that's $7. It doesn't, if I'm overdrafted for $100 for 5 months, I'm at $35. Then I would have been better off just paying the $35 fee, right? It just compounds the situation. It sounds great in theory, and the banks are going to go, yeah, this is fine. We're going to give everybody a $1,000 credit loan, or whatever it is, because they're going to figure out a way to make money on this. And this is always the problem with these solutions that remove responsibility from the consumer. It winds up costing the consumer more every single time. Every time we try to fix something in the system, it winds up making the people in the middle class and the poor even poorer. Because the banks are going to figure out how to game this. I'll just read to you a little bit more here. For example, consumers would apply for a credit, and institutions would underwrite that to determine the consumer's ability to pay. So now the bank's got to take on a bunch of people with poor credit. Now they've got to underwrite that credit line. Here's the other problem with that. You've got really crappy credit. You're a terrible payer. You're always in financial trouble. And I'm not saying you in particular, but there's a lot of people that are consistently in financial trouble. My daughter is one of those. I'm just teasing, not really. But the point is, what happens when the bank says, yeah, you're going to have to go somewhere else. We don't want you. See, what these proposals do is give more control to the banks to select what customers or consumers they want to deal with. Eventually, you start putting enough pressure on the banks are going to start saying, yeah, we're going to have credit restrictions on the type of customers we bring in. I'm not discriminating on race, religion, anything else. You're just a bad credit. I don't want you as a customer. No shirt, no shoes, no service. Right now, we don't have that problem. Anybody can pretty much open a checking account because the bank says, that's fine, open a checking account, that's no problem. You overdrafted, I'm going to charge you $30. If I've got to start giving you credit and I have to underwrite that credit and that credit is on my books, see, just charging an overdraft fee is fine. But once I have got to extend you credit, now that debt is sitting on my books. Those credit lines are sitting on my books. It's now a liability. So we'll see. We'll see what happens. But normally, when we have these proposals, these type of ideas, and they all sound great in theory, it's like, oh, we're going to protect the little guy. It doesn't really work out that way. And it winds up making things cost more. Or remove services from the general public altogether. And this is going to be, and it turns out to be something that we shouldn't have done. There's an old saying, it's like, if it ain't broke, don't fix it. There's some things that have been around for 50 years, 60 years, 70 years, 100 years. Don't fix them. They've worked. They still work. Leave them alone. But again, this is election season, so, we got to do stuff that says we're going to protect the little guy here. But again, I have a feeling that we're going to look back at this. If these rules, now this is just proposal right now, right? These rules haven't passed. But if these rules pass, it'll be very interesting to look back at this conversation, 2, 3, 4, 5 years from now and see how this turns out. We've done these things before. Generally, they don't turn out well, but we keep trying. Okay. Wrapping up the show this morning, futures down about 111 on the Dow right now. So, S&P's down, NASDAQ's down about 61. S&P's down 20-ish at the moment. So we're going to have a little bit of a slow open this morning. We'll see if the markets can kind of stabilize at the open and recover. And again, just this, we failed the Christmas rally, the Santa Claus rally. We failed the first 5-day rally. We're halfway through the month, and we need to get this market needs to get its act together if we're going to salvage the month of January, which kind of sets the tone for the year. So, again, we'll see what happens. But again, this morning a little bit sloppy. Be sure you're by the website, realinvestmentadvice.com. Get our latest blog post out. Michael's new blog post is out as well this morning. We'll discuss it tomorrow, which is the 1970s and inflation. It's a 3-part series that he started today on the website as well, realinvestmentadvice.com. And don't forget to get your ticket for the upcoming Economic Summit. It's next Saturday, not this Saturday, but next Saturday here in Houston at the Sonesta Hotel. Greg Valliere, myself, Adam Taggart, Michael Leibowitz be spending the morning with you talking about markets, investing, how this presidential election year will turn out. It's all next Saturday the 27th from 8 to noon. Tickets are on the website now. They are going pretty quick, so make sure and get your ticket now online, realinvestmentadvice.com.